The third main result of the capital asset pricing model concerns the expected risk premium of the market, and shows that that is a function of the average risk aversion level for the entire market and the market's expected risk. So just a quick sketch to show where this comes from. Recall that the Y star is the portion of wealth held in the risky assets. So we have this relationship that Y star for any portfolio is going to equal the expected return of the portfolio minus the risk-free. So the portfolio's risk premium divided by the portfolio's risk times this risk aversion level. But now, since we're not talking about a portfolio, we're talking about the whole market, I can substitute the market portfolio for some risky portfolio. And now let's just assume there's only 2 investors in the world, both with equal endowments. So if it's the case that the first person has a 40% of their wealth invested in the risky market portfolio, then it must be the case that they are lending 60% of their money. So 40% in risky, 60% lending. It must be the case that person 2 is borrowing what is lent, and so therefore Y2 must equal 1.6. Whatever is lent must be borrowed, whatever is borrowed must be lent. And so if it's the case that Y1 is equal to 0.4, then it must be the case that Y2 is equal to 1.6. The average of these two must equal 1, and if it's true for 2 people, it has to be true for 10 people, it has to be true for everybody. And so if I average everyone's Y, it must be the case that they average to 1, meaning that everyone's wealth equals essentially this market portfolio. And if we average across all the Y's, we also average across all the A's, and so we get the average level of risk aversion. And so 1 must equal the average Y, which is equal to the market risk premium divided by the average risk aversion times the market risk. And this is simple. I just pull this over and I end up with this result, that the market risk premium is equal to the average level of risk aversion times the market risk. And so I can see that the market risk premium is increasing in risk aversion. More risk aversion, the more people need to earn relative to the risk-free. And the riskier the market, the more people need to earn, really the expected market risk. So the next thing I want to do with this is I want to examine the relationship between the expected return of the market and the current market price to see if we can gain some insight as to why, when we see every day, why the price of the market goes up or the price of the market goes down. Let's see if we get any insight. So first, let's isolate the expected return of the market on the left-hand side. So I'm just going to pull the risk-free to the other side. And now I have that market return is increasing in the risk-free rate. If the risk-free gets bigger, the market return gets bigger. If risk aversion gets bigger, the market return gets bigger. And if the risk of the market gets bigger, the return gets bigger. But recall for a single stock that the expected return over some period of time is going to be a function of the current price and the expected price. And so now swapping out the return of a single stock and the price of a single stock for the market, I get this relationship. So now let's look at both of these together. And all I'm going to do is I'm going to add 1 and then solve for the price of the market. And so now I have the expected return of the market on the left-hand side, and I have the price of the market on the left-hand side. And note that the expected return of the market over any period, say the first period, I can substitute in for down here. And so let's consider how the inputs of the model will change both the expected return of the market and the current price of the market. So given these two relationships and given the fact that these two equations work together, if it is the case that the risk-free rate gets bigger, then the expected return of the market gets bigger. If the expected return of the market gets bigger, since it's in the denominator, the market price, the price of the market, you can think of this as the S&P 500, or you can think about this as some sort of broad index, is going to get smaller. And if the risk-free rate gets smaller, then the return of the market gets smaller and prices get bigger. Let's see if we can think about some intuition associated with this. So what I'm saying is if the return of the risk-free gets bigger, stock prices go down. Why is that? Well, maybe if this gets larger, then it becomes more attractive to many people. And so if the amount that I can earn in the risk-free gets large enough, if I'm sort of this marginal investor in risky stocks, then I'm going to sell those stocks and I'm going to put it into the risk-free. And so if the risk-free gets bigger, people sell stocks, prices go down. And if the risk-free rate gets smaller, it becomes less attractive. The expected return of the market gets smaller, and so prices get bigger. And so if the risk-free rate gets smaller, people move into stocks. Now let's look at average risk aversion. If the level of average risk aversion gets bigger, the return of the market gets bigger, and if the return of the market gets bigger, prices go down. If people are more risk averse, then they want to buy, they need to earn more from holding stocks. The way to earn more from holding stocks is to pay less for them. So aversion gets bigger, return gets bigger, prices go down. Aversion gets smaller, return gets smaller, prices go up. If people are less risk averse, then prices go up and they're willing to earn less from holding stocks. And then finally, if the expected risk of the market gets bigger, then people need to earn more from holding stocks. The return gets bigger and the price goes down. And so as risk gets bigger, return gets bigger, prices gets smaller. And then the opposite is true. If risk gets smaller, the return gets smaller and the prices go up. And so now looking at this result from the CAPM, we have this sort of an idea, this model, which can explain changes in prices in the market on a daily basis as a function of some alternative risk-free investment, some level of risk aversion, and the perceived risk of the market.